Michael Burry, the man who predicted the last financial crisis, is back in the headlines once again after he co-signed one of the most fascinating theories regarding the future of global finance. On October 20th, this anonymous Twitter user named Kankata tweeted 31 times breaking down something called the Great Sovereign Debt Intervention. A thread that became viral almost immediately and was co-signed by Burry, shocking many people. It's a thesis that, if true, would change the market in a way we have never before seen in history. In today's video, we break it down in a more simplistic tone, exploring how it could change the world forever and usher in a new era of financial conditions never before seen. As 2022 moves forward, it's very apparent that the entire financial system is coming under serious threat by currency collapses and wild government intervention. This is not an exaggeration. While a full meltdown has been avoided thus far, alarms have been sounding throughout the year. Read the headlines from England or Japan and you'll see exactly what I mean. We've had close call after close call, and one quick look at the yen or the pound reveals clues that something isn't right in the markets, and this thread attempts to explain what is happening and what the damage might look like if things do indeed fall apart. Kankata's thread begins with a simple foundation. It starts with the bond market. Yes, bonds are boring, but dig deep enough and you realize they run the world, serving as the foundation for the entire financial system. We're not going to go down that rabbit hole just yet, but understand that the once stable bond market is starting to act irrational. I'll explain in more detail later. Now, because bonds have become unstable, many experts throughout the world have started to worry that countries outside of the US will soon be forced to default, which will ultimately lead to a world contagion effect, bringing down all markets. While that may not make sense right now, it will by the end of the video. Now, this is where the real threat starts. The argument begins with this. It was obvious that in 2020, due to serious supply issues and money printing, inflation got out of control, going from the standard 2% to an outrageous 8.5%. To fight this, the Federal Reserve did what it had to do and it bumped up interest rates. Prior to March 2020, the rate was close to 0%, and over the next 24 months, it was brought up to 3%. You probably already knew this, but this development created some noise in the system, and this is where things started to get interesting. Now, outside of these boring numbers, the interest rate action has severe consequences for countries outside of the US. You see, when the Fed raises rates, it causes the US dollar to become strong. You can spot this correlation by just looking at this graph. The higher rates went, the stronger the dollar became. Now, as you may already know, the dollar is the worldwide reserve currency. 50% of all transactions use the greenback. It's the backbone of the worldwide financial system, and when the dollar rises like it is now, it puts severe stress on other countries. This is what everyone calls the dollar milkshake theory, and what the milkshake theory states is that while yes, fiat currencies are terrible for obvious reasons, they are not all created equal. Over the last decade, nearly every central bank in the world created tons of debt and printed money. You see, while people love to scrutinize the US government for printing a crazy amount of dollars to fund all kinds of things, everyone else around the world did the same. But our system is in theory better and more resilient to collapse. The dollar makes up 60% of foreign currency reserves, and outside of the US, there is nearly $13 trillion in US denominated debt. All of that money needs to be paid back in US dollars. This fact creates a lot of demand for the dollar. Everyone is after it since everything is paid using this currency. So what happens when all of a sudden the Fed decides to contract the supply of dollars in the world? Well, other countries begin to panic and they are forced to print their own currency to convert to USD to service their dollar-denominated debt. USD is pushed higher, accelerating this self-feeding cycle. One way to think about this is that there is a massive short squeeze on the US dollar. You can see from this graph that while everything else collapses, the US dollar appreciates, sucking up the milkshake of debt around the world. But what does this have to do with Burry and the Kankata tweets? Well, as this happens, treasuries begin to sell off, which pushes yields up. And when bond yields rise, trouble in the market typically begins. For example, just this week, bond yields have risen to levels not seen since the failure of Lehman Brothers. The trillions in stimulus plus the sharpest rate hiking cycle in decades has caused a significant sell-off in treasuries. And when this happens, you get volatility. Now, without getting into all the details, volatility is the #1 enemy for our financial system today. Look into almost every single prospectus and you'll find the volatility risk section. The truth is that our financial system functions great even in a downturn, as long as the downturn is slow, steady, and fluid. But when there is a panic and volatility spikes is when things begin to break. Now, as yields rise and volatility increases, we begin to enter something Kankata calls the illiquidity spiral. You can read about it in a separate thread, but essentially we will eventually hit a breaking point where volatility will rise, causing panic and illiquidity in the treasury markets, which will in turn cause yields to dramatically rise, which will force the Fed to intervene. If you paid attention to the news recently, England just had this happen with their version of the 10-year treasury called the gilt. The yields moved so much in one day that it caused severe issues for many pension funds, almost causing them to completely fail. This was fixed by rapid government intervention. But this event is just a small hint of what may come to markets soon. You see, central banks have many tools at their disposal to deal with these kinds of issues. How they will intervene is a complex topic, but essentially government mechanisms will aim to revive treasury market illiquidity and suppress volatility. The Merrill Lynch Move Index is a reliable indicator of this volatility, and right now it's approaching levels we have not seen since 2008. If things end up extremely bad out there, those simple mechanisms that have worked in the past will be unable to work today. So what will be their next move? Well, the officials will have to fire up their nuclear options, which means indirectly incentivizing large financial players to buy more treasuries. And you might be saying, well, that doesn't sound like free market capitalism. It's starting to sound like a planned economy, and in one way, you're absolutely right. You see, back in 2008, there was a set of regulations that essentially forced all banks to hold a certain percentage of something called high-quality assets. During a crisis, regulators can easily change these ratios, which basically force the banks to buy up treasuries. And if that's not enough, they can always introduce yield control, rent controls to discourage real estate investment, and stock taxes to discourage equity investment. All moves intended to force private sector money to flow into treasury markets. Monetary and fiscal magic will be pushed to new limits, but as Kinkada has stated, we won't even come close to a US sovereign debt collapse that many have warned about for decades. The US dollar is too entrenched in the system, and when trouble hits the market, there's really only one place to turn, and it's here in the United States. In summary, what this theory states is that when the Fed increases interest rates to battle inflation, it also creates an environment where the US dollar strengthens in a loop cycle. At the same time, treasuries sell off and yields rise, causing government intervention and a Fed U-turn that will save the market, but in its process, damage everything else. If you agree with Burry and Kinkada, let me know in the comments below. As always, thank you for watching. Please make sure you hit that like and subscribe button if you enjoyed it.